This is the economic and market report for the week ending July 8th of 2022 and also starting the week of July 11th, 2022. Uh, my personal sentiment right now is short term. I am 60% bullish, 40% bearish, and zero or 0% neutral. That's in the short term. In the midterm, I am 50-50. We're starting to enter a time period where I believe in the next 6 to 8 months, we're going to start to see a real deterioration in the markets and in the economy. Well, in the economy, the markets will be reflecting that. And then long term, I am 100% still bearish. Um, so that's my sentiment. Now, if we go to the investor sentiment, it dropped as I predicted last week or this week as of Wednesday, with 19.4% bullish, 27.8% neutral, and 52.8% bearish. So that's kind of where everybody else is a reflection of where everybody else stands. And things that I've been watching this week, especially, and I continue to talk about it, but is the GDP estimates for the second quarter. Um, and we'll be uh, getting that number here relatively soon. I believe the next week, um, as well as the CPI. But it was got to as low as the estimate being a negative 1.9% after the negative 1.6% first quarter. I As I mentioned, that this is a technical recession that we're in. It dropped a little bit down to a negative 1.2% in the estimate, but uh, things are contracting. And one of the things that came out today that I thought actually might begin to reflect it was the jobs report. But remember, the jobs report is a lagging indicator. The jobs are, I've gone through this, but in an episode, I'll put the link at the end, and that you can go to and watch that episode. I put about a 4 minute thing together about the Federal Reserve and why they're always behind. But we're at 375,000 jobs. That's going to lag where the actual economy is. I think we'll continue to see this number go down over the next, uh, months, weeks, months, whatever. And it's we're in a recession. I mean, that's the only way I can put it. How bad it gets, um, we'll talk about that, but primarily, um, I'm looking for a number of things to happen here, uh, especially a pivot from Powell, and I'm going to go through in my commentary about why I believe that he's got to pivot. But the recession's in there, as I mentioned. We're in a technical recession. I know there must be there's several opinions about how that's put together, including a group of economists, and I tried to use some of their figures, but a lot of it's kind of swag, if you will, and economic swag. And to me, whenever that happens, interesting numbers start to come out. But anyway, the jobs report was good. It is a lagging indicator, so I don't put a lot of merit in it as far as the way things are right now. The 10-year treasury, which I've been covering this week, got to a low here of 2.78%, and now it's at 3.086, and I don't like it over 3, but it's doing the tightening kind of for the Fed, but this isn't going to be enough. I mean, they're it's helping kind of slow some of the things down that need to be slowed down, but it's also hurting. So it's one of those double-edged swords. Things like mortgage rates can be figured off of this particular figure. But I look for it to. It may go up. I don't get nervous until it gets to about 3.25% or so. Gets over 3.5%. Boy, that's a that's a warning. But for right now, I still look for this number as we've seen over the past month or so. You can see that it's been trending down. We got this little piece here, but if you can see that the number has continued to go down. We'll see what happens in between now and next week. What my commentary basically is this: um, the chairman of the Fed, Jerome Powell, um, is going to raise rates. We can expect it another 3/4 of a point, and at some point, I think he's going to have to pivot. And let me explain why. First of all, he's trying to be Paul Volcker back in 1980, depending on how old you are. I was in college then, but Volcker was able to raise rates, into the high teens and to be able to get the economy back. And I'll show a different figure here in a second, but the federal debt over time, you can see just since 2001 has gone from, a little over 5 trillion now. I know the number today is definitely over 30 trillion in federal debt, and that limits your options, because for every percentage point that the Fed has to raise it, we get nothing for the interest we're paying on 30 trillion in debt. So in other words, it's just like a credit card. When your credit card interest rate goes up, that's money that can't go to anything productive. It's just dead money, if you will. And we've seen this number go up. So the situation has changed from the Fed standpoint. That the debt has gotten to the point where they will not be able to do it. It's what leads to bankruptcy, in essence. Not that the Fed can continue to print money, so it's never going to go bankrupt, but it can ruin a lot of other things, in the world economy. But, if we look at now here, we can go back to 1980, you can see that debt to GDP ratio was about 31%. Now, 124%. So our GDP isn't even bigger than our debt. So this is the problem that we face with regards to the Fed being able to fight this inflation that we have. Now they're talking a good game, and I know Jerome Powell is bringing out his inner Paul Volcker, and that's one of his heroes, but he's not going. It's not the same situation as Paul Volcker. He can't raise the rates to that, or else everything we work for will be for interest payments on our debt. There's only so far it can go, and people have been screaming for him to raise it to 5%. Well, what's 5% of 30 trillion? That's what, 1.5 trillion in just debt payments, an increase of. I mean, he can only go so far. So I'm curious to see how it plays out. I do believe he'll be forced to pivot, and that's one of the reasons is because of the debt. Another reason is because I know Joe Biden said, hey, you're an independent, part of the government, and you get to make your own decisions. But you get closer to the election, and there's going to be a lot of pressure on Powell to back off his rate increases, especially as this recession deepens as we head towards the midterms. And so that's a second reason that I think it might happen, and it might be a combination of these things. And the third is kind of is an interesting thing. I've been studying this for a while, for definitely over 2 years, watching it. But something called the milkshake theory, um, and the milkshake theory is something that uh, why we're seeing the U.S. dollar, which I don't have this week, increase. It's up around $104, I think, 104, 105, somewhere in there right now. And so the reason it's been elevated is because uh, other economies are in worse shape than we are. So we've seen some of the riots in Sri Lanka. We're going to see a lot more of this, especially some of the fringe economies that really are struggling. What they need is more dollars, and so there's going to be pressure on Powell to create more dollars, or the world economy goes under. So that's actually one of the things I plan on doing um, a video on this, either this week or the following week. I've got several on my list here, but the milkshake theory video, as well as links to it. Um, I want to do a video on strangles. Um, they're actually performing much better in my portfolio than the um, straddles, primarily because of the timing of the straddles. Things kind of calmed down a little bit. Some of them I bought before, they'd perform well. Others, I waited maybe a little bit too long because of the implied volatility went up. But I also want to do a video on the best way to make money in options. I'm not selling anything. I'm not trying to teach people how to do options. But again, I think people need to prepare, and they ought to start studying. And I actually have a good link to kind of a option school that's free, that people can watch and learn about options and how they work. But the best way to make money in options is definitely selling puts. And you know, I haven't found anything better. I've tried a number of things, including the straddles and strangles, ultimately. But that's one of the best strategies. The second one is doing covered calls, or something called the wheel strategy. But that'll have to come down the line. But just want to talk about the selling put options is like selling insurance on something, or being the house, in a casino, which is always a good thing. So there's a number of just small things that I point to. And again, I'm not trying to sell anything on this site at all. So I want it to be something that can be a resource for people, where they can get um, educated. And I think we all need to be educated in these things, especially now. So that's what I wanted to cover and this week. And remember, there is always a better way.